Hi guys, my name is Mike Boyd. This is the Money Flare, and it's that time of month again. It's April, early April, when all the YouTube finance personalities start to release their top stocks videos, top stocks for April 2021. High growth, don't forget it's high growth. I haven't watched these videos, so they probably have some good information. I don't need to really judge or anything. But I do find it kind of funny that they all use the same thumbnails and the same kind of clickbait titles. Although the title of my video is not really any different. So what's today's video all about? Am I calling for a market crash? Haven't I been pretty positive on the market lately? In my previous videos I mentioned how we're in an environment of increasing growth and increasing inflation, and that the yield curve is showing that steepening. So it's showing that we might be at the beginning of the next cycle, right? So it doesn't really make sense. How could I be calling for a market crash? Just because the long-term cycle is up doesn't mean that there won't be any short-term corrections along the way. If you guys remember back in January and December 2018, the market fell pretty hard, 10 or 20%. And it wasn't the end of the previous cycle, but they were pretty significant market corrections. And if you remember, as I've been saying a lot, with this low liquidity environment and with the whole passive component, markets are really fragile. And so any corrections that do come tend to be pretty violent and pretty quick. Don't forget what happened with ViacommCBS and Discovery most recently. Archegos Capital, that hedge fund that sort of exploded and caused those stocks to crash, they were not the only ones that were using excessive leverage and taking on a lot of risk. There's a lot of leverage in the system right now, and when that leverage unwinds, it can unwind pretty violently. So to put any concerns at ease, I don't believe there's going to be a stock market crash anytime soon. I actually want to jump on the bandwagon and make my own sort of top stocks for April 2021 video. But I do want to be transparent with this channel and to be honest about what I'm doing with my own portfolio in the hopes that my sharing my views can maybe help others who are watching and who are managing their own portfolios. And so I do want that transparency. And so in my opinion, even though I don't think there's going to be a crash anytime soon, I don't think now is the best time to be buying stocks. I think we're entering a pretty risky environment right now for multiple reasons. So what makes me believe that stocks might be in for correction sometime soon? There are a few technical indicators that I'm tracking and some market indicators that are suggesting that we might be entering a period of risk-off price action for stocks. As I mentioned in the previous video, we're also seeing a lot less speculation in the options market from the small retail traders. Capital gains is another big one. Long-term capital gains are coming due now for people who had these large gains from last March. And we're also seeing some pretty extreme positioning and sentiment in the market right now. So people are really complacent. So all this combined with the low liquidity, the sort of fragile market environment that we have now, means that we're getting into some pretty risky territory. And the common saying of sell in May, go away might come early this year. So first for the technical indicators. The market's definitely showing some pretty extreme signs of exhaustion. So here's a chart of the S&P 500, and it's definitely getting into some overbought territory. So ever since March 25th, it's been going up without any major pullback or any major correction. It's just been going straight up. And what I like to use an indicator here, which is the 20-day moving average in purple, along with the standard deviation bands above and below that moving average. And so what this is just showing you is that whenever price gets into the either upper or lower regions of that 20-day moving average, that's a sign that price is getting pretty extreme either to the upside or the downside. And so these bands here are the 2, 2.5, and 3 standard deviation bands above the price. And so the market, S&P 500, has been hugging that 2 standard deviation band for a few days now. And so the longer this happens, the more I start to get on edge and start to think that, okay, we might be ripe for at least a short-term correction or at least a pause in this sort of upward price action. Another sign that we might be seeing some pretty extreme valuations right now is the global equity market cap to GDP ratio. So this is the ratio of the total market value of all stocks in the world divided by world GDP. And previously it made an all-time high in August 2007, and now we've eclipsed that all-time high. So now we're at all-time high equity market cap to GDP. And I don't generally like to look at valuations too much because valuations are never a catalyst. Just look at Tesla, for example. Tesla had a large valuation for such a long time, but it never caused a crash or a correction. So valuations are never catalysts for corrections or for crashes, but it is important, I think, to keep in mind to keep these things in mind, especially when they're at extreme levels like they are now. But price is only one aspect, and in my opinion, it's also important to keep in mind what volume and volatility are doing. So in terms of volume, how does that look? Well, last week saw some of the lowest volume in 2021 so far. So Monday, Tuesday, Wednesday, Thursday, and Friday were 5 of the lowest volume days in the market so far this year, and Friday was the lowest day of volume. And so you're seeing price increasing on decelerating volume. And typically that's not a good sign. That's a sign of market fragility and weakness. You really want to see price increasing with increasing volume to really have that conviction. And so this is not really a good sign to see volume decreasing like this. So we're seeing some worrying signs in price. We're seeing some worrying signs in volume. What is volatility doing? So here's a chart of the VIX, which is the S&P 500 implied volatility. So this is what the market expects the volatility of the S&P 500 is going to be over the next month or so. And as you can see here in March, the VIX really spiked. So that was when we were having that COVID crash. So typically when markets fall, volatility rises. And when markets go up, volatility goes down. But that's not the whole picture. And so what volatility also tells you is how complacent or how worried is the market feeling right now. And so right now with volatility crashing, to me that's sending me a signal that the market's really not worried in the short term for any market volatility, even though we're at all-time highs. When the VIX is higher, it usually means that the market's a bit more cautious. So market participants might be hedging, or they might be buying downside protection or some market insurance, some puts, for example. So people are a little bit more on edge, and they're a little bit more worried about protecting from any drawdowns. But right now, with the volatility decreasing so much like this, and especially decreasing below a key level that it held all throughout the pandemic, which was around 20, now it's at 16. This is a sign that people are feeling a lot less worried about any future volatility. And in fact, if you look at the put-call ratio, so this is the ratio of the number of puts bought versus the number of calls bought. So if you remember in a previous video, I mentioned that when you think the market's going to go up, you buy calls. And when you think the market's going to go down, you buy puts. So they're options. And right now, the number of investors, or the number of investors buying puts versus calls is at very, very low levels. We haven't seen these low levels since December 2013. So right now the market, these two signs, right, the low volatility and the low put call ratio, to me signals that the market is very, very complacent. No one's really hedging, no one's really buying any protection or buying any market insurance. There's a lot of complacency going on right now. When I see this kind of complacency, it makes me a bit nervous, or at least it puts me on high alert, because the market never crashes when people think it's going to crash. But it often does crash when no one's expecting it, right? So just take November 2020 as an example, the elections last year. Everyone thought it was going to be a major event. There was going to be a lot of volatility in the market. And so people were protecting themselves. People were preparing for it. They were hedging. They were buying some protection. They were getting prepared for this event. And when the event happened and it wasn't as volatile as people expected, then all of those negative positions, so all those hedges and all that downside protection, had to be unwound. And what that does is that acts as sort of fuel to bring price further up, right? And so that's an environment that I prefer. I prefer that much more than when people are really, really complacent and no one's really protecting themselves or hedging, which gives the market a bit more fragility, and that can cause large spikes in the VIX. So like here in February 2020, the VIX was low when it spiked before COVID. So VIX decreasing, volatility decreasing, to me is a bad sign. Equity positioning is also looking to be pretty extreme. People are getting really, really confident in the market, and so they're allocating to stocks like they've never done before. So here's a chart of the Bank of America clients and their holdings of stock positions, and it's at the highest it's ever been. The previous peak was in March 2015, and now we're at the highest it's ever been. Another indicator of sentiment is the AAII survey. This is a survey that's done with investors, and they're measuring the amount of bullish investors, so the amount of investors that think the market's going to go up, versus the bearish investors, the amount of people that think the market's going to go down. And so that spread, that difference between those who think the market's going to go up versus down, is at the highest it's been since 2018, since January 2018. So we have extreme positioning and also extreme sentiment. People are getting really, really confident in the market right now. So overall, we have price that is getting to be pretty extreme and looking to be very, very overbought on decelerating volume and decelerating implied volatility. We also have some pretty extreme market positioning and some pretty extreme market sentiment with investors thinking that the market's going to keep going higher. All this sort of combined puts me on high alert. This raises warning signs in my head. So what are some other signs that we could see from the market that could suggest that we're going to be going into more of a risk-off period? One of them would be utilities. Utilities have been outperforming the market over the past month or so. And utilities are more of a defensive sector. They're more defensive stocks in nature. And whenever they outperform the market, like they have been most recently in March, and like they did in September, so if you see in September, the market was having a lot of volatility. There was a pretty big correction that happened, two big corrections that happened in September and October. And before that happened, we saw utilities start to outperform. So the market was getting more defensive. It wasn't really so risk on, it was getting more risk off. And this is what we're seeing now. We're seeing utilities outperform, and we're also seeing consumer staples start to outperform. Consumer staples are also more of a defensive sector. We're also seeing the dollar rise most recently, which is another potential sign of some risk-off behavior. Gold as well. Gold was going down pretty hard since August, but now it seems to have bottomed, and it's looking like it wants to sort of make higher highs and resume an upward trend. It's kind of starting to reverse right now, which is a sign that, once again, we might be going into more of a risk-off environment, as well as we might see, this might also be a sign that real rates are maybe taking a pause from going up, right? So that environment that we've had over the past month of increasing growth and increasing rate, that whole trade might be taking a pause, at least for the time being. So that's another sign that we have to look out for. Another one is copper, the copper to gold ratio, right? Copper typically outperforms gold when we have the economy doing really, really well and we're growing and we have inflation increasing. So when this ratio is increasing, that's a good sign. But right now it's looking like it's rolling over, which once again is at least a short-term sign that we could be going into more risk off right now. So with that being said, I'm on high alert right now for potential market top, or at the very least for price to stop going up and to maybe move sideways. I don't really know what's going to happen. I can't really predict the future, but all these signs and signals that I showed you guys, to me, they are warning signs that we are entering kind of a risky environment. And so I'm not buying stocks right now. I'm actually reducing some of my exposure. I'm selling some of my stocks, taking off some risk, holding more cash, trying to prepare a bit for the potential of more volatility going forward. I might even buy some protection in the near future. I don't want to be too early because I think the market could go higher. I think things could get more extreme before we have maybe a drop in the future. There's no harm in being defensive with your portfolio sometimes. You can't predict what's going to go on in the market, but you can gauge probabilities. And I'm hoping I was able to show you guys some of the signs and signals that tell me at least that we are entering a period of maybe a higher probability of a market drop or a market correction. And so there's no harm in being a bit more defensive and preparing for that possibility. And if I'm proven to be wrong, right, it's not a big deal. I can just reallocate into stocks. I can buy back the stocks I sold, fully invest in the market again, and maybe I miss out on some price appreciation. But in my opinion, I'd rather be safe than sorry. I'd rather be on the safe side and avoid a 10 or 20% drop than to see 1 or 2% gains when the market's so already overbought, right? And so it's all about probabilities. And right now the probability, as I said, is to me pretty high that we could see a correction. And this is not financial advice. I'm not a financial advisor, so I'm not advising any of you to sell your stocks, right? But I would advise caution, at least. In my opinion, I would be a bit more cautious right now. I wouldn't buy stocks. And so for that reason, I'm not making my April 2021 top stocks video. I kind of want to warn some of my viewers that, in my opinion, we could see some volatility going forward. So we'll see what happens. If I'm right, then that's great. And hopefully this video could help anyone watching to protect themselves as well. But if I'm wrong, then okay, I'll pivot and I'll admit I'm wrong and I'll reallocate the stocks, and hopefully the upward trend can continue. We'll see what the market's going to do. Anyway, thank you guys for watching today's video. Be sure to like and subscribe, and I'll see you guys in the next video. Take care.